Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourself, Banking and General Knowledge, etc. Today I will discuss two group discussion topics related to the internal promotion examination for banks. Welcome to part 8 of my Path to the Corner Office 2025 to 2026 series, where we break down real bank promotion exam questions and give you clear practical sample answers about group discussions to help you climb the career ladder faster. Group discussions topic. First, GST and its effect on the banking and business sector. Second, credit growth versus risk management in banks. GST and its effect on the banking and business sector. The Goods and Services Tax, implemented in India on July 1st, 2017, marked a revolutionary shift in the country's taxation system by replacing multiple indirect taxes like excise duty, service tax, VAT, and custom duties with a single unified tax. GST simplified compliance, improved transparency, and aimed to create a seamless national market. However, its introduction also brought challenges, particularly for the banking and business sectors, which had to adapt to new processes, reporting norms, and digital systems. While GST offers numerous benefits in terms of efficiency, formalization, and revenue mobilization, it also entails compliance burdens, cash flow issues, and technological adjustments. A balanced analysis of GST's impact is essential to understand its implications for both banks and businesses. Positive effects, pros, and arguments in favor of GST. First, simplification and uniformity of taxation. Before GST, businesses faced a complex web of state and central taxes, leading to confusion and inefficiencies. GST has streamlined the tax structure by creating a single uniform tax regime across India. This simplification reduces administrative burdens and compliance costs, especially for businesses operating in multiple states. Digitalization of transactions and reporting. GST is heavily reliant on digital platforms for registration, invoicing, and filing returns. This digitalization has accelerated the adoption of technology in businesses and banking operations. Banks benefit as GST compliant businesses maintain proper accounting records, which improves credit evaluation, loan processing, and risk assessment. Enhance transparency and reduction of tax evasion. The GST system, with its invoice matching input tax credit mechanism and online reporting, reduces the scope for tax evasion. Businesses maintaining clear records help banks assess financial health more accurately, thereby improving lending decisions and credit risk management. Fourth, formalization of the economy. GST encourages businesses to operate formally to avail tax credits, thereby broadening the tax base. Formal businesses are more likely to engage with banks, seek financing, and adopt structured financial management. This leads to deeper financial inclusion and strengthens the link between the banking system and the real economy. Fifth, better cash flow management. Though GST requires timely payments, the input tax credit mechanism reduces the cumulative tax burden and allows businesses to adjust taxes paid on purchases against output liabilities. For banks, this means businesses are more likely to maintain transparent cash flows, making lending and working capital assessment more efficient. 6. Facilitation of interstate trade. GST has eliminated the cascading effect of multiple state taxes, making interstate business easier and cheaper. Banks supporting business expansion benefit as enterprises grow their operations seamlessly, increasing the demand for big banking services like loans, trade finance, and working capital. Negative effects and cons and arguments against GST. First, compliance burden and complexity for small businesses. Despite simplification, GST compliance requires timely filing of multiple returns, accurate record keeping, and familiarity with digital systems. Small and medium enterprises often struggle with this, increasing the risk of errors, penalties, and stress. Banks dealing with SME loans may face delays or disputes over financial statements affected by GST compliance issues. Second, initial cash flow pressure. GST operates on a payment first, credit later mechanism in many cases, requiring businesses to pay taxes upfront and claim input tax credits later. This can strain working capital, especially for small businesses with limited liquidity. Banks may need to adjust loan structures, offer short term working capital support, or manage credit exposure more carefully. Third, technological challenges. GST requires businesses to adopt digital accounting software and e-invoicing systems. Many small businesses, particularly in rural or semi-urban areas, face challenges in upgrading technology. Banks may also need to adapt internal systems to verify GST compliance and integrate these records into credit evaluation. Fourth, initial confusion and regulatory uncertainty. The frequent amendments and clarification notices issued by GST authorities initially created confusion for businesses. Misinterpretation of rules can lead to penalties, disputes, and delayed payments. Banks, when assessing financial statements and loan applications, may encounter inconsistencies due to GST adjustments. Fifth, impact on informal sectors. Many informal businesses and cash based operations are outside the GST framework. For banks, this creates a gap, as such businesses are harder to evaluate for loans or creditworthiness due to incomplete records. While GST promotes formalization, the transition phase poses challenges for both banks and businesses. Balanced comparison. GST has both transformative benefits and traditional challenges for the banking and business sectors. On the positive side, GST encourages transparency, formalization, and digitalization, factors that strengthen the banking ecosystem. Businesses maintain structured records, enabling banks to assess credit risk accurately, reduce NPAs, and offer better financial support products. GST also facilitates expansion across states, increasing demand for trade finance, loans, and investment banking services. However, the negative aspect cannot be ignored. The compliance burden, cash flow pressures, and technological requirements may create short term operational and financial challenges, particularly for SMEs. Banks may need to provide working capital loans, technology support, and advisory services to keep businesses transition smoothly. Moreover, businesses that fail to adapt may face penalties affecting their creditworthiness and indirectly impacting banks' risk exposure. From a macroeconomic perspective, GST creates a more robust and transparent business environment, which ultimately benefits banks by increasing the formal credit market and reducing systemic risks. Nevertheless, banks and businesses must invest in capacity building, automation, and process optimization to maximize the benefits of GST. Arguments for GST in banking and business. Simplifies taxation, reducing administrative burden, enhances transparency, reducing evasion and credit risk, encourages digitalization and proper record keeping, promotes formalization and financial inclusion, facilitates for interstate trade and business expansion, improves assessment of cash flows and lending decisions. Arguments against GST in banking and business. Compliance is complex, especially for SMEs. Cash flow pressures may increase short term financial stress. Technological and digital adaptation may be challenging. Frequent changes in rules create uncertainty. Transitional phase affects informal businesses and banks' exposure. Conclusion. GST has fundamentally transformed the business and banking landscape in India. Its impact is overwhelmingly positive in the long term, creating a transparent, digital, and formal economy. Banks benefit from improved record keeping, better credit assessment, and increased engagement with formal businesses. Businesses gain from reduced cascading taxes, uniformity, and smoother interstate trade. However, GST also poses challenges, particularly for SMEs and informal sectors. Compliance, technological adaptation, and cash flow management require careful planning and support from banks. Transitional difficulties may affect short-term profitability and credit management, but these challenges are largely manageable through process optimization, digital adoption, and capacity building initiatives. A balanced view suggests that GST is a strategic enabler of growth, formalization, and financial efficiency. While it requires efforts and adaptation from both banks and businesses, its long-term benefits outweigh the initial challenges. GST strengthens the foundation of a modern, transparent, and integrated economy, making banking and business operations more efficient, accountable, and growth oriented. Credit growth versus risk management in banks. Credit growth and risk management are two fundamental yet sometimes conflicting objectives in banking. Credit growth refers to the expansion of loans and advances to businesses, individuals, and governments, which drives revenue generation, economic activity, and financial inclusion. Risk management, on the other hand, is the systematic identification, assessment, and mitigation of potential losses, particularly credit, market, and operational risks. While aggressive credit growth can enhance profitability and support economic development, it can also increase exposure to defaults, non-performing assets, NPS, and financial instability if not managed prudently. Conversely, excessive risk aversion can limit lending opportunities and slow economic expansion. Balancing credit growth with effective risk management is therefore critical for the sustainable performance of banks. Positive aspects and pros and arguments in favor of credit growth. First, economic expansion and development. Credit growth fuels investment, business expansion, and consumption. Banks that increase lending support entrepreneurs, small and medium enterprises (SMEs), infrastructure projects, and consumer credit, stimulating economic activity and job creation. Higher lending helps GDP growth, which indirectly strengthens banks' own asset quality over the long term. Second, revenue and profitability enhancement. Loans are primary source of income for banks through interest and fee-based income. Aggressive credit growth allows banks to expand their earning base, improve net interest margins, and enhance profitability. Third, financial inclusion. Credit growth can promote financial inclusion by extending banking services to previously underserved populations. By providing loans to rural areas, women entrepreneurs and micro businesses banks contribute to social and economic development while diversifying their customer base. Fourth, competitive advantage. Banks that grow their credit portfolios effectively gain market share, attract loyal customers, and build long-term relationships. In a competitive banking environment, credit growth can signal dynamism, market leadership, and proactive strategy. Fifth, portfolio diversification. Expanding lending across sectors and geographies allows banks to diversify credit risk, potentially reducing the impact of sector-specific shocks if managed prudently. Negative aspects and cons and arguments against excessive credit growth. First, increased credit risk. Rapid or aggressive lending can lead to poor credit assessment, mispricing of risk, and exposure to high-risk borrowers. This can result in rising NPAs, loan defaults, and provisioning requirements, directly affecting profitability and capital adequacy. Second, asset quality deterioration. When banks focus extensively on growth without proper risk evaluation, the quality of their loan portfolios may decline. Lending to untested borrowers or volatile sectors can create long-term financial instability. Third, over-leverage and systemic risk. Excessive credit growth can contribute to over-leverage among borrowers and macroeconomic imbalances. If a significant portion of loans turns non-performing, banks may face liquidity crisis, threatening the broader financial system. Fourth, regulatory scrutiny and penalties. Banks that prioritize growth over prudence may violate regulatory norms regarding capital adequacy, provisioning, or exposure limits. This can lead to penalties, reputational damage, and additional oversight from authorities. Fifth, short-term focus versus long-term sustainability. Aggressive credit expansion for immediate profits may compromise long-term risk resilience. In pursuit of growth targets, banks might neglect rigorous monitoring, resulting in delayed detection of credit deterioration. Positive aspects and pros and arguments in favor of risk management. First, ensures long term stability. Effective risk management safeguards banks from unexpected losses by monitoring borrower creditworthiness, exposure limits, and sectoral risks. Banks maintain financial stability, protect depositors, and preserve capital. Second, improves asset quality and reduces NPAs. Prudent risk management through capital appraisal, monitoring, and recovery mechanisms reduces loan defaults and ensures healthy asset quality. This protects profitability and regulatory compliance. Third, regulatory compliance and investor confidence. Banks that implement robust risk management frameworks comply with Basel III norms, RBI guidelines, and capital adequacy requirements. This business investor confidence reduces borrowing costs and enhances reputation. Fourth, encourages disciplined growth. Risk management promotes sustainable lending by balancing potential returns with associated risk. It encourages banks to lend responsibly, diversify portfolios, and avoid overexposure to risky sectors. Fifth, mitigation of operational and systemic risks. Beyond credit risk, effective risk management addresses market, operational, and liquidity risks. Banks are better prepared to respond to shocks such as interest rate fluctuations, currency volatility, or economic downturns. Negative aspects and cons and arguments against overemphasis on risk management. First, slower credit growth. Excessive caution may result in underlending, particularly to new, smaller, innovative businesses. While risk is minimized, opportunities for revenue growth and market share expansion may be lost. Second, reduced competitiveness. Banks with overly conservative lending practices may lose clients to competitors willing to take calculated risks. This can weaken market position and limit brand visibility. Third, inflexibility. Rigid risk management systems may delay loan approvals, making banks less responsive to market opportunities. Clients may perceive them as bureaucratic or slow, impacting customer satisfaction. Fourth, potential for over collateralization. In the pursuit of minimizing risk, banks may demand excessive collateral, limiting access to credit for small businesses and startups that cannot meet stringent requirements. Fifth, opportunity cost. Avoiding risk entirely may result in missed revenue opportunities in sectors with high growth potential. Banks must balance the need for safety with the potential rewards of innovative lending. Balanced comparison. The relationship between credit growth and risk management is inherently a trade off. On one hand, credit growth drives profitability, market expansion, financial inclusion, and economic development. On the other hand, unchecked credit growth without proper risk mitigation can jeopardize bank stability, increase NPAs, and attract regulatory penalties. Conversely, a strict focus on risk management ensures asset quality, regulatory compliance, and resilience, but may limit growth, reduce competitiveness, and slow economic contributions. The optimal strategy lies in a balanced approach. Banks must pursue credit growth strategically, guided by robust risk assessment and monitoring frameworks. Diversification across sectors, prudent exposure limits, credit scoring models, and real time monitoring allows banks to expand lending without compromising asset quality. Simultaneously, a disciplined risk management culture enables early detection of stress, proactive resolution, and compliance with regulatory norms. Advanced analytics, digital banking platforms, AI-based credit scoring, and real-time monitoring tools are tools that help banks achieve both objectives simultaneously. They allow faster loan dispersals while maintaining stringent risk checks, making credit growth sustainable. Arguments for prioritizing credit growth drives revenue, profitability, and market share, supports economic development and financial inclusion, diversifies portfolio if managed prudently, encourages innovation and customer acquisition, enhances employment and sectoral growth. Arguments for prioritizing risk management: maintains long-term stability and solvency, reduces NPA and credit losses, ensures regulatory compliance and investor confidence, prevents systemic risk and overexposure, promotes disciplined and sustainable growth. Conclusion: credit growth and risk management are two sides of the same coin in banking. Credit growth fuels profitability, market expansion, and economic development, while risk management safeguards the bank's financial health, regulatory compliance, and reputation. Neither can be pursued in isolation without compromising long term sustainability. The most effective strategy is a balanced, integrated approach where credit growth is guided by rigorous assessment, portfolio diversification, and monitoring systems. Banks must leverage technology, data analytics, and innovative lending models to achieve scalable, responsible growth. Similarly, risk management should be flexible enough to support emerging sectors, startups, and underserved populations without exposing banks to excessive danger. In a sense, sustainable banking requires a symbiotic relationship between growth and risk management. Growth without discipline leads to crisis, discipline without growth leads to stagnation. Banks that successfully balance these priorities are better positioned to serve customers, support economic development, and ensure long term financial stability. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.